Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today we're talking about how government could be a partner in your home ownership. This week, the Canadian government announced a new program that, as far as I know, is the first of its kind anywhere in the world. The measure would make it easier for first-time home buyers with household incomes less than $120,000 a year to buy a home. But in this case, the government would register a lien against the equity in the home, not just the debt. Under the program, the buyer would bring a 5% down payment in the form of equity. This is the same as the high-ratio loan that's currently offered by the federally owned mortgage insurer, the Canada Mortgage Housing Corporation, or CMHC. The incentive would allow first-time home buyers who have a minimum down payment for an insured mortgage and to apply to finance a portion of their home through a shared equity mortgage with CMHC. The government is expecting that approximately 100,000 first-time home buyers would be eligible to benefit from the incentive over the next 3 years. Since there's no ongoing payments required for the incentive, the Canadian government is going to actually be funding those down payments directly. So let's work through an example. Let's say the borrower purchases a $400,000 home with a 5% down payment, and then the government kicks in 10% for a total of $40,000. The borrower's loan amount is going to be the purchase price minus the 5% down payment minus the 10% contribution from the government. So their mortgage is going to be reduced from $380,000 to $340,000. That's going to reduce the borrower's monthly mortgage cost by about $228 a month. They're going to be offering the first-time home buyers this 10% shared equity mortgage for new construction or a 5% shared equity mortgage for existing homes. The larger amount is really designed as an incentive to encourage new home construction in some of the most supply-constrained cities in Canada like Toronto and Vancouver. The terms of the announcement are not completely clear. From what I understand, it's more like an interest-free loan, one where the repayment plan doesn't require a payback until quite a few years in the future. What's not completely clear are what are the terms for removing the government from being a partner in your home. I suspect the path to repayment for most people would be either the sale of the property or refinance into a conventional loan. The simplest case involves the sale of the property. In that case, I think the payout's pretty clear. The bank records a first lien mortgage on the property, then CMHC records a second lien position for 10% of the value, and on sale of the property, the first lien gets satisfied. The second lien would also get satisfied, and depending on what the rules are for the equity share, there could either just be no profit shared with the government or potentially some portion of the profit would flow through to the government. The scenario of a refinance is not nearly as clear. There are a number of private companies offering similar products in the marketplace. In the case of the private offerings, it is not free money. A prospective buyer has to get approved for a mortgage just like they normally would. They've got to come up with the minimum down payment. And of course, the buyers pay back what they owe, plus a corresponding share of any gains down the line to the partner company. The private companies who offer this service are making an equity investment in the property without co-signing on the debt. Toronto-based nonprofit developer called Options for Homes, which is currently working on more than 600 units in the Toronto area, has been in business for 25 years, and in that time, they've funded nearly 3,000 units and experienced only 5 defaults in that time. That's a pretty enviable track record. The Toronto market's been extremely robust over the last 25 years. If the equity partner owns a share of the profits proportionate to the respective equity shares on the property, the partner would definitely come in getting the majority of the price appreciation. Toronto home prices have increased a lot over the last 25 years, an average of 9.4% a year. Clearly, those types of price increases are not sustainable, but if you're in the equity share business, you would have certainly been on the right side of history over the past 25 years. Now, the government budget is far from clear on how much the buyer would owe. Is it the same as the actual upfront equity contribution, or will the bill go up based on how much the property is appreciated? Government officials say the details of the plan are going to be hashed out in the coming months. I don't really know how I would feel about having the government own a portion of my home. In my case, I'm not eligible anyway because I'm not a first-time home buyer. The other question is whether Canada really needs the program. Canada overall does not have a home ownership problem if you look at global statistics. In the last census in 2016, 67.8% of Canadians owned their own homes. Even in expensive Toronto, 66% home ownership. That compares with 63.4% in the US and falling. Other major world capitals like Paris are at 33%, Berlin 37%, and London at 47%. Nevertheless, I consider this an innovative program that certainly other governments around the world will be watching very closely to see how it performs. So you think about that. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.